Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Peter Laurelli. He's the global head of research over at eVestment. We're going to take a look at one of their most recent surveys on hedge fund asset inflows and outflows, and this is the sixth consecutive quarter of hedge fund outflows. Peter, it's great to have you with us at Market Site as always, and that's quite a streak there. 6 quarters of money coming out of the hedge fund system.
Yeah, so the streak is 6 quarters, and on a monthly basis, that's 11 of the last 12 months. It's been a tough time for the majority of products in the space, and it's happening on the back of generally disappointing returns in 2018.
Do you think that's a trend that's going to continue? It seems as if the hedge funds are having a really tough time competing in today's landscape with with indexing and smaller fees and trying to outpace their benchmarks.
Yeah, so if only it were a simple answer. It's more of it depends. One thing we've noticed that although the news has been kind of consistently bad at the top level, when you dig down within every strategy and every kind of period that we look at it, there are products that are being successful, whether from a performance standpoint or from a flow standpoint. And it boils down to the products that are actually kind of meeting or beating their investors' expectations. Looking at year to date, the 20 products with the highest inflows, every single one except for one was positive last year in a period where the industry was down about 5.5%. They're up again this year. And on the other side, the 20 products with the highest outflows, I think 18 of the 20 were down last year with an average return of, I think, down around 6%. So it is possible to be successful. It's just not as easy as it used to be.
All right, let's take a look at some of those segments there. The biggest redemptions were among long and short equity funds and multi-strategy funds.
Yep. Long short equity is kind of at the top of the kind of not meeting expectations.
Right, no, their benchmark would be the S&P 500.
It depends. These are global products, often investing in various markets around the world. So looking at like the MSCI World, for example, that's up, at least through September, it was up around 14-15%, I think, whereas long short equity products are up around 8-9%. Going back to even within all the bad news, you can find good news. Some of the highest or most successful asset raising products so far this year have been in the directional equity space. It's just a matter of being able to navigate what are kind of increasingly difficult kind of homogenous markets successfully, and some can do it, and they are seeing the benefits.
All right, now the biggest allocations were to relative value credit funds and managed future funds, so totally different end of the spectrum.
Yeah, and that's in the month. That theme hasn't played out for the year. Take the managed future space, for example. They've the last 2 months there have been very kind of targeted allocations to that segment. I think year to date, 70% of those products have seen outflows. In the quarter, I think it was even around 60%, still seeing redemptions. But recently, it just shows that, first looking at the group as a whole, billion-plus managers there underperformed last year. I think it's about 70% of those have recouped last year's losses, and they are, as a group, leading the industry this year. But it's bringing a fair amount of volatility, and that's tough for institutional investors to stick with. But there are products there that are successful.
All right, what do you think about the hedge fund industry overall? Do you think we'll see some M&A and consolidation within the space?
Absolutely, consolidation. I think we've long gotten past the point where we think about this set of products as one kind of group that has success or failure as a whole. And I think investors around the world are seeing them as a group of individuals that some are successful and some aren't. And that's going to continue. In the process, I think we'll see more and more funds go out of business, but also new funds launch when the right opportunity is there and the right manager has kind of the right vision for wherever he's or she is allocating.
Yeah, I mean, do you think we'll start to see more in the alternative space? Because that seems to be everyone's looking for alternative forms of generating alpha beyond your typical long shorts and multi-strat funds.
Yeah, where we're seeing a lot of demand is in private markets. Allocations have been consistent there. Mandates being fulfilled there have been consistent in private credit, private equity, real assets. So I expect there where cash flows are more of the norm than kind of volatile returns, or I think that's what the investor type who were predominantly looking at hedge funds in the past are looking for now.
All right, Peter, thanks so much for joining us at MarketSite.
All right, you're welcome.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.